The Psychology of Investing. Chapter 10. Social Confirmation and Herd Behavior. A hot stock tip feels powerful because it usually arrives with more than information. It comes with urgency, confidence, and emotional energy. And those qualities can make weak ideas feel strong. When someone says, "You need to buy this now," your brain often reacts to the pressure before it evaluates the evidence. Tips also tend to arrive in familiar settings like lunch, group chats, or workplace conversations, which makes them feel more trustworthy than they deserve. That social comfort can blur the line between a casual opinion and a real investment case. The important point is that a message can feel convincing because of how it is delivered, not because the underlying stock is actually attractive. Peer pressure enters investing most strongly when you are unsure. In uncertainty, people naturally look to others for cues, and a confident group can make following along feel safer than standing apart. If several people sound certain, fear of missing out starts to build, even if you originally had questions. At that point, the social risk of saying no can feel larger than the financial risk of making a rushed decision. That is how group confidence begins to override personal judgment. The danger is not simply that others influence you. It is that their certainty can substitute for your own analysis. One of the easiest mistakes to make is treating repetition like proof. Many stock tips do not begin with special insight at all. They begin with one rumor, one old article, or one unsupported opinion. As that claim gets repeated by more people, it starts to sound established, even when nobody has verified it. Confidence grows as the story spreads, but the evidence may remain exactly as weak as it was at the start. This matters because many voices can still be echoing the same thin claim. A stock does not become a good investment just because a rumor has traveled widely. When you rush under social pressure, the first thing you usually skip is the basic work. You may buy after excitement has already pushed the price higher, which means you are entering when expectations are elevated. At the same time, weak fundamentals can go unnoticed because you never pause to check revenue, profits, debt, or cash flow. That creates a situation where you are taking real risk without clearly understanding the business. Even if the stock rises for a while, the decision process is still fragile. Good investing begins with evaluating the company, not with reacting to hype around the company. Herd behavior often follows a very recognizable pattern. First, you hear an urgent tip that sounds too promising to ignore. Then other people repeat it with confidence, and your hesitation begins to fade because the idea seems socially validated. Before long, you act without doing enough research, and the outcome depends more on luck than on judgment. Sometimes that process leads to a gain, but a lucky result does not mean the decision was sound. Recognizing the pattern early is valuable because it gives you a chance to interrupt it before emotion turns into action. A simple mental reset can be surprisingly powerful in these moments. Start by separating the story from your reaction to the story. The tip itself is only an opinion, and the pressure you feel is only an emotion. Neither one is a command to act. That distinction creates a small amount of space between impulse and decision. Once you create that space, you can move from urgency to evaluation. Often, better judgment begins with nothing more dramatic than reminding yourself that you do not have to respond immediately. Consider Roberto, who heard co-workers excitedly predict that Digicore could jump 30%. Their confidence made the opportunity sound obvious, so he invested $2,000 without checking the company for himself. Soon after, a launch delay pushed the stock down 25%, and Roberto lost $500. The financial loss matters, But the larger lesson is about process. He did not make a decision based on business evidence. He made it based on group enthusiasm. That distinction is important, because the same flawed process can eventually produce much larger losses. The best immediate defense against herd pressure is a short pause. Waiting even 24 hours can weaken the emotional spell of urgency and help you think more clearly. During that pause, check one basic fact, such as earnings, sales, or recent company news. Look for confirmation from the company itself or from a reliable outside source, rather than relying on the social momentum around the idea. You also do not need to commit in the moment. A simple response like, "I'll take a look," preserves your independence. The goal is not to reject every tip, but to stop treating excitement from other people as if it were research. The most common mistakes in hot stock situations all come back to the same confusion, mistaking confidence for evidence. Investors get into trouble when they act immediately, silence their own questions, or assume a group cannot be wrong. Another frequent error is treating a tip as if it were already researched and verified. In reality, confidence only tells you how strongly people believe something, not whether it is true. Slowing down helps you notice that gap, and once you notice it, you are much less likely to let social pressure make the decision for you. The same social forces that show up in conversations become even stronger online. An echo chamber forms when the same view is repeated so often that it starts to feel unquestionably true. In investing forums, that repetition can quietly replace analysis with social reinforcement. Disagreement becomes less visible, not necessarily because it is wrong, but because it gets buried, ignored, or discouraged. Over time, the group experiences familiarity as certainty. That is why repetition can feel like proof, even when the evidence underneath is still weak. Online forums are especially vulnerable because agreement is highly visible. Upvotes, reposts, comment counts, and confident language all create the impression that a claim has been deeply confirmed. But those signals mostly tell you what is popular inside that community, not what is true in the market. A weak idea can look strong when it is surrounded by enthusiastic social feedback. Exciting stories also spread faster than careful analysis, so bold claims naturally dominate attention. The result is that visible consensus can feel persuasive long before real evidence has been established. Echo chambers often form in a predictable sequence. A bold claim appears first, usually stated with certainty rather than caution. Early supporters amplify it, adding agreement, excitement, and repetition, while skeptical voices get buried or brushed aside. Soon the same claim shows up across multiple threads, giving the illusion of many independent confirmations. In reality, those separate discussions may all trace back to the same original rumor. By the end of the cycle, the group begins treating the claim as settled fact, instead of a hypothesis that still needs testing. There are a few warning signs that tell you a forum may be rewarding agreement more than accuracy. One is confidence without evidence, where people make huge claims but provide no filings, numbers, or verifiable sources. Another is repetition being mistaken for proof, where the same idea appears everywhere but no one has checked whether it is actually true. A third sign is that questioning gets punished, mocked, or treated as disloyalty. Healthy communities can handle skepticism because they care about getting the facts right. Unhealthy ones protect the story instead. It is important not to confuse every active forum with an echo chamber. Good communities can surface interesting ideas, identify risks, and share useful research that you might not have found on your own. In those spaces, disagreement is part of the learning process, and claims improve when they are challenged. Group pressure feels different. It rewards loyalty, pushes people toward agreement, and makes doubt seem like betrayal. The key question is whether the discussion is testing the idea or defending the idea. Insight invites scrutiny, while an echo chamber resists it. Repeated claims feel true because familiarity itself is persuasive. When you see the same statement over and over, your mind starts to process it more easily. And that ease can be mistaken for accuracy. Add many voices and strong emotion, and the claim starts to feel socially proven. At that point, analysis becomes harder because the group already sounds settled. But markets regularly show that consensus can be wrong, especially when excitement outruns evidence. A popular claim may still deserve the simple question: what facts actually support this? Emma gives us a clear example of how to respond well. She reads repeated posts claiming that a biotech company called Nextcore is guaranteed to receive FDA approval within weeks. Inside the forum, the story sounds certain because dozens of comments repeat it confidently. But when she checks outside sources, she finds that the approval timeline is still months away and that safety concerns have also been raised. The forum created the appearance of certainty without the substance of confirmation. Emma's advantage is not that she knew more at the start, it is that she verified the claim before acting. A simple cross-check can protect you before any forum-driven trade. Start by writing down the exact claim, because vague excitement is hard to test. Then find at least 2 outside sources and separate direct facts from speculation. Ask whether those sources are truly independent or whether they all trace back to one original rumor. If the evidence lines up, you may have something worth studying further. If the support is thin or circular, waiting is often the smarter move. The discipline here is simple. Decide only after the claim survives contact with evidence outside the group. Investors often misuse forums by confusing social signals with proof. Upvotes are not evidence because popularity does not verify a business claim. Repetition is not verification, especially when many posts are repeating the same source. Another mistake is assuming the loudest or most visible posters represent everyone, when many thoughtful participants may be silent. It is also a mistake to see skepticism as negativity. In investing, skeptical questions are often what protect you from expensive errors. The healthiest habit with online forums is to use them as idea generators, not as final authorities. A popular thread may point you towards something worth examining, but popularity itself is never enough. In fact, when a group sounds most convinced, that is often the best moment to slow down and verify elsewhere. Check company filings, neutral reporting, or primary documents before you make any decision. This keeps the forum in its proper role, a starting point for research, not a substitute for research. That same discipline becomes even more important when the broader media begins amplifying the story. Once a story escapes a forum and reaches the media, attention itself can start driving investment decisions. A sharply rising stock attracts headlines, interviews, and social chatter, which makes it feel important and validated. New buyers often respond to that visibility rather than to the company's underlying business. The danger is that attention can create an emotional sense of value that is very different from actual value. A stock can be heavily discussed and still be overpriced. The essential question is whether the excitement is being supported by evidence or simply amplified by coverage. This is where the bandwagon effect takes hold. People naturally feel drawn toward what already looks popular, because visibility can resemble credibility. If a stock is everywhere, investors may assume that someone else must have done the research already. That assumption makes buying feel safer than it really is. But popularity is not a safety feature. it is often just a sign that attention has become concentrated. Joining the trend may feel rational in the moment, even when the underlying reasoning is weak. Hype distorts value by giving the most exciting part of the story far more attention than the less flattering parts. Headlines tend to focus on breakthroughs, dramatic momentum, or huge upside, while risks such as weak cash flow, heavy debt, or slowing sales receive less emphasis. This imbalance matters because attention and business value are not the same thing. A company can be fascinating and still not be worth its current price. Over the long run, fundamentals determine results much more than publicity does. When hype is loud, it helps to ask what the headlines are leaving out. Hype often builds through a self-reinforcing cycle. A trigger event draws attention. The media amplifies the story, and social proof encourages more people to buy. Rising prices then create even more headlines, which attract additional buyers and often bring in short-term traders chasing momentum. Each stage strengthens the next, so the process can feel like confirmation when it is really feedback. As the loop grows, risk rises with the price, even though many participants feel increasingly confident. That is how visibility starts to replace evidence. Reversals can be abrupt, because hype-driven moves depend on a continuing stream of new buyers. As long as fresh money keeps arriving, the rise can look unstoppable. But once the story reaches a peak and those new buyers begin to slow, early investors often start taking profits. Momentum can then break very quickly, because the same crowd that helped lift the stock can rush to the exit together. Late buyers are usually the most exposed, since they entered when expectations were already extreme. In these moments, price often weakens before the public mood catches up. GameStop in 2021 is a vivid example of media hype, online excitement, and market mechanics combining into one extreme move. Attention on Reddit pushed the stock into the spotlight, and news coverage framed it as a dramatic battle between retail traders and hedge funds. A short squeeze then added powerful buying pressure, helping drive the stock from roughly $20 to more than $480. The speed and scale of the move attracted even more people, many of whom arrived near the top. For late buyers, the excitement of the story did not protect them from large losses. The episode shows how quickly attention can overwhelm any normal sense of valuation. The lesson is not that every widely covered stock is bad. Sometimes media attention brings useful information to investors and highlights a company that genuinely deserves study. The problem begins when headlines and price excitement are treated as proof of value. Dramatic language can amplify emotion, but it cannot replace evidence about revenue, profits, debt, and cash flow. Good investing asks what facts support the story and whether the business can justify the price. Coverage can inform you, but it should not make the decision for you. During a frenzy, investors tend to make a familiar set of mistakes. They mistake coverage for research, buy simply because a stock is popular, and assume the trend will continue because it has been strong so far. Many also forget to ask who benefits from the story, whether that is promoters, commentators, or traders who entered early. Another common error is waiting for one more spike, even when the risk of reversal is already growing. These are not random mistakes. They are the natural result of emotion, attention, and crowd behavior feeding each other. Recognizing them can keep you from participating at the most dangerous moment. When a stock dominates the news after a big jump, a simple self-check can restore perspective. First, list the dramatic headlines you remember, because that shows you how much of your impression is story-driven. Then, write down 3 important facts you still do not know, such as revenue trends, profitability, or debt. It also helps to imagine what happens if the price falls back toward pre-hype levels. Could you still justify buying it? Finally, ask whether the coverage explained the business or mainly excited the audience. That question often reveals whether you are reacting to information or to theater. One way to protect yourself from these cycles is to develop a contrarian pause. When prices rise quickly, buying can feel safe simply because everyone else seems optimistic. When prices fall sharply, selling can feel safe for the same reason. In both cases, the crowd is often reacting emotionally rather than analytically. Contrarian thinking creates a pause between that shared emotion and your decision. It does not require you to be bold or unusual. It simply helps you become less reactive. Contrarian thinking is often misunderstood as automatic disagreement, but that is not what it means. A good contrarian does not oppose the crowd just to feel independent. Instead, the real question is whether the crowd's view actually fits the evidence. That means asking, what if the consensus is wrong? And then testing that idea with facts, valuation, and assumptions. Sometimes the evidence will support the crowd, and sometimes it will not. The point is to let analysis guide the decision, not ego or reflex. The crowd can be wrong because markets move on expectations, not just on facts. Good news may already be priced in, which means even strong results may not lead to higher prices. In other cases, hype can push a stock above a reasonable estimate of value, while panic can push it below. That is why popularity is such a poor substitute for quality. A company can be widely admired and still overpriced, or widely feared and still fundamentally sound. Contrarian thinking begins by noticing the gap between expectations and reality. A contrarian check protects you from several predictable crowd errors. It can stop you from buying overhyped investments late in the move, when excitement is highest and upside may be limited. It can also keep you from selling strong holdings in a panic, when fear temporarily overwhelms judgment. More broadly, it helps you avoid confusing attention with quality and emotion with opportunity. The pause is valuable because it turns a reactive moment into an analytical one. Before following the crowd, you ask whether the price reaction actually makes sense. A simple contrarian process makes this practical. Start by naming the popular belief as clearly as possible, because vague sentiment is hard to test. Then ask why that belief might be wrong, and what assumptions are built into it. Look for missing facts that the crowd may be overlooking, and compare the possible upside with the possible downside. Only after that should you decide, and the decision should come from evidence rather than mood. This turns skepticism from an attitude into a disciplined method. The strongest contrarian questions are specific. Ask whether the stock is already overpriced relative to realistic business performance. Check whether the market is reacting to genuinely new information or just rediscovering old news. Look closely at fundamentals such as debt, earnings, and cash flow to see if they support the excitement. And ask the most important question of all, will this news materially change future profits? These are grounded questions, and they help keep contrarian thinking tied to facts rather than instinct. Imagine a small tech company that jumps 40% in a week after announcing a contract with a retailer. Forum discussions quickly turn that event into a story that the stock could double. A contrarian response is not to deny that the news is positive. It is to ask whether the contract is large enough to justify such a dramatic move. If the financial impact is relatively small, then the market may be responding more to excitement than to economics. In that case, choosing not to buy is not pessimism, it is disciplined judgment. Contrarian thinking matters on the downside as well. Suppose a large company falls 30% after a temporary production problem and investors rush to sell. A contrarian does not buy automatically just because the price dropped. Instead, the question is whether the damage is temporary or permanent. If cash reserves are strong and the core business remains sound, panic may have created an opening rather than a warning. Here, the contrarian advantage comes from separating short-term fear from long-term business reality. Contrarian thinking only works when it stays humble. A common mistake is believing that doing the opposite of the crowd is automatically smart. Another is ignoring strong evidence simply because it supports the consensus. Disagreement by itself is not analysis, and confidence in your independence is not proof that you are right. Markets can punish both herd behavior and contrarian ego. The better approach is disciplined skepticism, careful timing, and a willingness to change your mind when the facts demand it. The practical habit to build is the contrarian pause. Before acting on a popular idea, identify what the crowd is excited or worried about, and then ask what fact could challenge that view. From there, decide whether buying, selling, or waiting makes the most sense. Finally, state your reason in one clear sentence. If you cannot explain the decision simply, you may not understand it well enough yet. The goal is not to reject the crowd automatically. It is to make choices you can defend with evidence. That leads to the final discipline in this chapter: independent verification. Repeated stories can create a false sense of certainty, especially after they pass through friends, forums, and media coverage. Popular opinion may feel persuasive, but it is never proof by itself. Claims can be outdated, exaggerated, or built on incomplete information. Verifying an idea for yourself helps separate social momentum from actual evidence. In that sense, verification is one of the clearest ways to reduce herd-driven decisions. Independent verification begins by going back to the exact claim. If someone says a stock always beats the market, or that a new product will double revenue, write that statement down clearly. Then trace where the claim came from rather than stopping at the person who repeated it. Look for original information, such as company filings, earnings reports, or direct statements from management. Once you find the source, judge the evidence for yourself, instead of inheriting someone else's confidence. The shift is simple, but powerful, from repeated belief to direct evidence. This habit matters because it creates a pause between emotion and action. Verification interrupts social proof by forcing you to ask what is actually known. It also slows impulsive decisions, which is especially useful when hype is rising or fear is spreading. Instead of buying because others sound excited, you return to the facts. And during market declines, the same process helps you think more calmly rather than reacting to the mood around you. Verification does not eliminate uncertainty, but it improves the quality of the thinking that happens before you act. The process itself can be very simple. First, write down the claim clearly enough that it can be tested. Then identify the original source and look for primary documents such as filings, earnings releases, or regulatory statements. After that, cross-check with at least one independent source to see whether the same facts hold up elsewhere. Finally, compare the evidence with the original claim and ask whether the claim is supported, unsupported, or still uncertain. The goal is not to defend the idea you heard, it is to test it honestly. When you examine evidence, focus on things that can be directly checked. Numbers, dates, and direct statements are much more useful than vague adjectives like huge, soaring, or guaranteed. Look at whether the actual trend matches the claim being made. Separate commentary from evidence, because summaries often exaggerate what the data really shows. Then, force yourself to reach a clean conclusion, supported, unsupported, or uncertain. That discipline prevents wishful thinking from quietly filling the gaps. Take the example of a friend who says TechCo's new app will double revenue next quarter after hearing it in an online stock group. When you verify it, the company does confirm that the app launch is real, but the release gives no revenue forecast, which already weakens the bold claim. Then the latest report shows that the app's current revenue is far below what would be needed to double total company revenue in a single quarter. So the exciting story and the available numbers do not line up. That does not prove the company is bad. It shows that the specific claim is not supported by the evidence you found. The bigger lesson from that example is how little evidence you sometimes need to challenge a bold story. The claim sounded exciting, and that excitement could easily have pushed someone into a quick decision. But a few basic facts were enough to show that the story was running ahead of reality. In a case like that, adding the company to a watch list may still be reasonable. What is not reasonable is treating the tip alone as a reason to invest. Verification helps you separate interesting from investable. Most verification mistakes come from rushing or checking selectively. Investors often rely on only one source, treat opinion as evidence, or stop after reading a headline or summary. Another subtle error is being skeptical only of ideas you dislike, while giving a free pass to ideas you want to believe. Some people also give up when the material feels technical, even though a plain language explanation is often available with a little effort. Good verification does not require perfection. It requires using the same honest standard for every idea, especially the ones that already appeal to you. A practical way to build this habit is to use one recent investment tip as an exercise. Write the claim as specifically as you can, then identify where it came from. Find one objective source, such as an earnings report or filing, and locate one concrete number related to the claim. After that, explain in plain language whether that number actually supports the story. This is a small exercise, but it trains an important reflex. Instead of asking, "Do I like this idea?" you begin asking, "What does the evidence say?" The goal of verification is not certainty. Markets will always contain incomplete information, changing conditions, and outcomes that no one can predict perfectly. But checking claims is still worth the effort because it improves your judgment. You do not need a crystal ball. You need a process that makes you less vulnerable to herd behavior, hype, and repeated stories. Evidence-based habits will not make every decision correct, but they will make your decisions more independent and more explainable. And in investing, better judgment is a much more realistic goal than perfect prediction.